What if I told you there's a strategy that could help you pay off your 30-year mortgage in just 7 to 10 years and potentially save you tens of thousands of dollars or more in interest payments? But here's the catch. If you mess this up, you could literally lose your home. This is Velocity Banking. By the end of this video, you'll know exactly how it works, whether it's right for you, and the one critical mistake that could cost you everything. Hey, I'm Adam Carroll, the TEDx speaker with over 6 million views about a game of Monopoly I played with my children with cold, hard cash. And I'm also the founder of the Shred Method. This channel is your go-to for smart and strategic money moves with your home equity. And if you're carrying debt, whether that's a mortgage, credit cards, or personal loans, this video is going to be a game changer. We're breaking down Velocity Banking step by step, what it is, how it uses your home equity and a HELOC to accelerate debt payoff, and most importantly, whether it's actually safe for your situation. What is Velocity Banking? All right, let's start with the basics. What exactly is Velocity Banking? Simply put, Velocity Banking is a debt repayment strategy that uses a home equity line of credit, or HELOC, to accelerate paying off debts that are quietly siphoning tens of thousands of dollars from you, especially your mortgage. To tee this idea up, if I told you that your car was idling in the driveway right now and has been for hours, what would you do? You'd go turn it off, obviously, because it's a waste of gas, it's hard on the engine, and ultimately it's just inefficient. But let's be honest, your paycheck, or at least some portion of it, is idling in your checking, savings, or money market account for days, weeks, or even months. And point blank, this inefficiency will cost you millions in future net worth. Here's the core idea behind Velocity Banking. Instead of letting your paycheck sit in your checking account while your mortgage and other debts keep costing you significant interest, you run your paycheck through your HELOC. At certain points throughout the month, you'll make lump sum payments to the principal of your debts, knocking them down rapidly. Your income deposits lowers the HELOC's daily balance, which cuts down on overall interest charges. When you use your HELOC to make large lump sum payments against your mortgage principal, it permanently reduces the total interest you'll pay over the life of the loan, and it shortens the overall life of the mortgage, often to between 3 and 7 years, depending on your income and your expenses. The magic happens because HELOCs use simple interest that is calculated on your average daily balance, while mortgages are amortized, meaning the interest is front-loaded in those early years. And by attacking that principal early, typically years 1 through 5, and aggressively through the HELOC, you can potentially turn a 30-year mortgage into a 3 to 7 year payoff. At the end of this video, I'll share how the Shred Method can take all of the guesswork out of this process for you and guide you to your own financial freedom point, where you have enough income being made passively that your monthly expenses are taken care of. Before you get too excited, let me show you exactly how this works in practice. The step-by-step process. Here's the Velocity Banking cycle in 5 simple steps. Step 1, open a HELOC using your home equity. The best place to start is where you do your personal banking already. You will need at least 15 to 20% equity in your home typically to qualify. If you don't know the difference between a HELOC and a home equity loan, watch this video next. Step 2, draw a lump sum payment from your HELOC. How much is determined by your discretionary income and the timing of your payments, and immediately pay this lump sum towards your mortgage principal or whichever debt makes the most sense to pay off first. Step number 3, set up direct deposit so your paycheck goes directly into the HELOC account. This instantly reduces the average daily balance as soon as that deposit is made. Some lenders don't allow direct deposit directly into a HELOC, and if so, direct deposit into checking and move the money the day of. Step 4, use your HELOC for all of your monthly expenses. Either use this through a linked debit card on the HELOC or by transferring money as needed from HELOC to checking. Step number 5, repeat the cycle. As your HELOC balance drops from your income payments, you can draw another chunk to attack your mortgage again. The key insight here is timing and interest calculation. You see, your paycheck hits the HELOC early in the month, or maybe twice a month, dramatically reducing the average daily balance for that entire month. Meanwhile, your expenses trickle out slowly out throughout the month. With the interest savings from that lower average balance, it can be substantial. Crunching the numbers. Let's look at an example to see how powerful this can actually be. Meet Chris. Chris has a $300,000 mortgage at 4% interest and opens a $50,000 HELOC at 7.5% interest. The traditional approach looks like this. Chris's normal mortgage payment is about $1,432 per month. Over 30 years' time, Chris will pay approximately $215,000 in total interest. Here's the velocity banking approach. Chris draws $7,500 from his HELOC and immediately pays down his mortgage principal. Then he directs his $5,200 monthly income into the HELOC, paying out his $4,825 in monthly expenses throughout the month. Here's what happens. That $5,200 paycheck immediately drops his HELOC balance on day one. Throughout the month, his expenses slowly increase the balance back up, but the average daily balance, what he actually pays interest on, is much lower. After a few months of this cycle, Chris can draw another lump sum from his HELOC to attack his mortgage again. The result is this. Chris pays off his mortgage in years, not decades, and he saves tens of thousands of dollars in interest payments he would have otherwise paid. That is real money staying in his pocket. Here's the real takeaway. Chris would likely have just spent the extra that he had every month on random unintentional things. It's money that would have just idled in an account. But give it a strategy and a place to go, and it will increase Chris's future financial freedom immensely. Now, this is a super simplified version of what we do with the Shred method. The benefit of working with us is our software does all of the heavy lifting for you. Every lump sum deposit is calculated to the penny to guide you to the official payoff date. We even have a savings calculator that will give you a sense of just how much you can save. It is linked down below in the description. Pros and cons. Now, this sounds pretty amazing, right? Most people, when they hear this, they tell me it's too good to be true. It feels like magic, but it's not magic, it's math. But let's be honest in this about both the benefits and the risks. We'll start with the pros. Accelerated debt payoff. We're talking about cutting your mortgage timeline to 1/3 or less what you originally signed up for. Massive interest savings. Tens of thousands of dollars staying in your pocket instead of going to your lender over the course of the life of your mortgage. Flexible access to funds. Your HELOC gives you a financial safety net and super simplified cash flow. Everything will begin running through one account system, making it easier to understand where your money is going. You'll be able to cash flow your life expenses, things like braces for kids, college costs, vacations, even a new car, all through this cash flow tool. No more payment mentality. Now, here are the cons, and these are critical. The first one is variable interest rates. HELOC rates can rise, so it's best to have a system that keeps your overall HELOC debt load in check. An extra point or two in rate can cannibalize your discretionary income real quick. Foreclosure risk. Your home is collateral for the HELOC, so if you can't pay, you could lose your house. This is also why it's important to not only have a system, but a community and coaches guiding your process. This requires strict discipline. You've got to have more money at the end of the month, not more month at the end of your money. So you must have positive cash flow and be able to stick to a somewhat formalized budget. Our software is like a behavior modification program. So if you have trouble sticking to a routine, this will help. HELOC terms and traps. Some HELOCs have funky terms and conditions, or they can be frozen by the bank. So knowing what to look for when signing up is key. I cannot stress this enough. Velocity banking is not a magic bullet, and it's definitely not for everyone. You cannot borrow your way out of a spending problem. So this strategy requires you to be extremely disciplined with your finances and comfortable with variable rate debt. It doesn't have to be a lot to work effectively, and my team can show you how that works if this is right for you. So how do you know if velocity banking is right for your particular situation? I want you to ask yourself these 4 critical questions. Question number 1. Do you have enough equity in your home that you can qualify for at least $10,000 to $15,000 on a HELOC? Without significant equity, it may be harder to get the right amount on that home equity line of credit. Question number 2, is your cash flow strong and stable? You need consistent income that exceeds your expenses every single month. If you are currently living paycheck to paycheck, this strategy isn't right for you yet. Question number 3, are you disciplined with money? This isn't a set it and forget it strategy. You actually need to actively manage your cash flow and resist the temptation to overspend, especially when you may have more access to the ability to spend. Question number 4, are you comfortable with variable rate debt? HELOC rates can change, sometimes dramatically. So if rates spike another percentage or two, are you comfortable with pivoting the strategy? Here are some red flags that mean you should not try this. Irregular income. Your income is super irregular month to month. Highs and lows, super variability. This might not be an ideal scenario for you. Already struggling with debt payments. If you are in over your head on monthly payments, you've got to do 2 things. You've got to play strong offense, meaning make more money, and you've got to play really strong defense. That means spending less. Poor spending discipline. This typically looks like not knowing where your money is going every month. You just know it doesn't stay at home. If you're planning major life changes like a job loss or retirement, here's what I'd say. Get stable, understand your budget well, and then come back to this when you're in this category. Beyond debt payoff. Now, here's where velocity banking through the shred method gets really exciting. Once you've eliminated your debts using this strategy, you don't stop. You actually redirect that powerful cash flow toward building wealth. All that money that was going toward debt payments can now flow into index funds and investment accounts, real estate investments, business opportunities, and building your emergency or opportunity fund. The key is that the shred method doesn't just eliminate debt. It creates a mindset and a system for managing cash flow that can accelerate your entire financial journey. Listen, velocity banking isn't magic, it's math. It's discipline and it's strategic use of financial tools that are largely available to almost anyone. This can dramatically accelerate your debt payoff and jumpstart your wealth building, but it's not for someone looking to be passive and disinterested in finances. This requires active management, typically 15 to 20 minutes a week, and a solid understanding of your own financial situation to make this work. So if you think you're ready to explore this strategy, there's a free savings analysis calculator that lets you model your own numbers and see if this makes sense for your particular situation. You can grab that link in the description below. Hit that like button if this helped clarify velocity banking for you. Subscribe here for more advanced money strategies, and drop a comment letting me know, are you considering this strategy or do you think it's too risky for your situation? I read and respond to every single comment. Thanks for watching. And remember, the goal isn't just to pay off debt faster. It's to take complete control of your financial future. Your home shouldn't be just your largest liability. It should be your number one asset building tool. I'll see you in the next video.